Welcome to our Learning Lab Live week 4. So this is our Flexi Payment Term Lifetime Mortgage, and you are watching this presentation as you have requested this on demand. So if you want to watch any of the previous sessions that we have run, which have been the market update, tailored enhanced and our medical proposition, and also the affordability segment as well, which leads nicely into this week, then you can request them online on demand. So first and foremost, there are 4 customer personas that we are looking at with regards to this particular product. The first and foremost would be the customer who's looking for the higher release, but is of a much younger age. So we're seeing many cases at the moment where people are coming through, they're wanting that 55, 57-year-old customer who's looking for that much higher borrowing, and they can't just quite achieve it from an equity release point of view. So this product will work really, really well for them. You've also got those customers who can achieve that higher release, okay? They can get that equity release, but what they do like about this product is that it travels with a much lower rate. So they've got a willingness and an ability to make a payment, and actually for them, it could work very, very well. You've also got all of the customers who are perhaps coming out of their normal sort of mortgage and they're considering the options of TOs and RIOs in the marketplace. And it may well be that they're actually entering an earlier retirement stage. And from that point of view, perhaps their income in retirement doesn't meet the affordability rules. So from an affordability fail point of view, again, this is a product that would be really good for that type of customer. And then we've got all of those people who are coming out of the interest-only trap, possibly come off of a 5-year fixed rate. We're seeing interest rates that are sort of spiking, have spiked over time, and people are then really struggling to sort of be able to afford that mortgage. What they also don't want to do is be in a situation where they kick the can down the road and they have the problem 5, 10 or 15 years on and are still in the same position. So they're the main 4 customer personas that we see that this product would work really well with. But how does Flexi PTLM itself actually work? So in essence, it's providing customers between the ages of 55 to 62 access to higher loan to values than they would normally be able to achieve on a normal Flexi Choice product. And it's for those borrowers who are looking to release a cash lump sum, as there is no drawdown on this particular product. But these customers must have an ability and an appetite to make a mandatory payment. All of the loan to values are determined by the youngest borrower, as would be in a normal equity release situation, and all mandatory repayments must be completed by the time the oldest borrower reaches age 66. So the loan itself, so this is a hybrid mortgage, okay, and it's where the product is a lifetime mortgage in the main, and where there is a commitment to mandatory payments that enable a higher initial loan to value, but at those flexi choice rates that help the client to secure a lower total cost of borrowing. And all we're saying is that higher amount that they can borrow will then be subject to an affordability assessment, and it will be stressed on first death terms. So I'm going to repeat that. So it's just the higher release that is subject to the affordability assessment. The rate on this product is fixed for the entire life of the loan, and once the mandatory repayments cease, the mortgage continues and behaves in exactly the same way as a traditional lifetime mortgage would do. So what are the benefits of a flexi payment term lifetime mortgage? Well, it's a type of equity release that allows your client to borrow more money at a lower rate of interest than they would be able to get through a comparable lifetime mortgage. And in return for that, they're committing to us to make a mandatory monthly payment until the oldest borrower turns age 66. And by doing so, they could release up to 8% more of their home's value tax-free. So what does this show here on this slide as a loan to value comparison? So what we've got on the bottom is we've got the customer age, and on the vertical axis, we've got loan to value. And what this is displaying is that a 55-year-old, okay, in essence, could achieve that 8% more borrowing. But in essence, they would almost have to be aged 60 to 61, okay, before they could get the same amount of borrowing in terms of a normal equity release mortgage. Now, Obviously, because this is a mortgage that requires a part interest payment, then basically what we have to do is we do have to assess the income and the expenditure. So in simple terms, the income itself is income before tax, okay, and it's gross income for the employed and net profit for the self-employed. And we do require evidence of this, okay, and we will require multiple sets of evidence, and we'll explain why in a second. But in essence, what we will do is there's three breakdowns of what we've got in terms of what we look at. So on the credit file, we look at committed expenditure, and this would be credit cards, overdraft loans, hire purchases, any buy-to-lets that somebody might have that are in excess of the stress test, and also any education and care costs. So these are committed costs on a monthly basis. And then we have the essentials, which are basically, gas, electricity, your telecoms, that type of thing, or any pensions or insurance premiums. And we will take the actuals from those. Then you've got the discretionary spend as well, okay? So this might be alcohol, tobacco, sort of recreation goods, so it could well be the gym membership or the golf club membership. Now, from this point of view, we will take the higher of the actuals, okay, that you give us, or alternatively, we will work on the higher of the Office of National Statistics for that area. So we look at those three different things, and what we'll do is we'll take that from either the income or the net profit, okay, and then that will give us an amount of money which we can work with basically in order to support the mortgage payment. But when it comes to income, what are there as acceptable sources? Well, in essence, okay, it is an earned income, okay? And what we're looking at is typically sort of 100% of anything that would be guaranteed. But if anything else is regular, okay, then basically we'll consider 50% of that. We'll look at it over a 3-year period, and that will be averaged out. And in essence, what we need to see is 3 months pay slips, corresponding bank statements, and it may well be that we need to see those P60s as well, okay, particularly if there are things like bonus and commissions to be taken into account. So we do have to see sort of multiple sources. So when it comes to the income, obviously that would be verified by pay slips, but also it would also be verified as an entry onto the bank statements as well. When it comes to the self-employed, essentially what we're looking at here is you need to be self-employed for at least 2 years. Now, overall, we need the SA302s, the tax calculations, and 2 years tax overviews as well. However, depending on the type of self-employment that you have and you are as a business, will depend on the additional information that we need to go through with those pieces of paper. Now, self-employment can be quite complicated from an income point of view, and we have some highly specialised underwriters that have been brought in specifically to deal with tackling income like this. So if you do have any queries, then please do get in touch with us, and actually what we can do is sit down and work this out with you. But it's worth noting on here that contract workers we will also accept as well, and basically it's a minimum of 12 months that you would need to be having a contract for. You'd either need to renew that contract or sort of be in that second contract. And the way that we work that is we'll take the weekly rate of income and we multiply that by 48 weeks, which is actually slightly better than it would be in the residential world. Now, we're often asked if we can take into account benefits, and unfortunately we can't take state benefits into account. But what I would say is if you have a person that's basically receiving a PIP or a personal independent payment that is guaranteed for life, okay, let's have a conversation about that customer and that client and their income that they're receiving, and we'll put that to the funder to see if we can do that as an exception. So, just to give you an example here of how this would work. So this is Stephanie, and she's 55 years old. She's got a house worth £285,000, and she's looking to release as much as she can. And on our Flexi Lifetime mortgage, that will allow her £64,125, which is 22.5% loan to value. It travels with an interest rate of 6.94%. But, okay, this is not enough because she's got a shortfall and needs to repay her mortgage. By taking out a flexi payment term lifetime mortgage, it has been identified that she has got the ability to make monthly payments. And if she were to commit to paying us £264 a month, what that would actually do is that would achieve an additional £22,800 in borrowing. And it actually travels with a cheaper interest rate, 6.86%. So all she has to do is commit for 11 years, basically, to pay us £264 a month. Once she reaches age 66, then basically those payments will cease. Now, she also has the ability to make an overpayment, because you can still overpay by 10% of the initial loan. So she can do that during the payment term period, or actually once that's finished, she can also make those voluntary payments as well. Now, it's a great way to help control the total cost of borrowing for the customer. So in this example, we're going to work from the right-hand side to the left. So what we've got here is a 58-year-old gentleman. He's got a house worth £285,000, and he can release £77,805. And this is based on one of the highest loan-to-value type products. So this would be like an Apex type product. The rate of interest is 8.6%, and basically he doesn't have to make any payments to us because it's a standard equity release mortgage. His total cost of borrowing would be £281,352 over an assumed term of 15 years. Now, let's say, for example, you've gone through the client's situation, you've looked at bank statements, you know what income they've got, you've verified that, and actually he can pay £244 per month. So let's say he took that Apex type of lending, okay, at 8.6%, but he chose to make a monthly payment of the 244. And let's say he did that for a period of 8 years. So that would reduce the total cost of borrowing down from 281,000 to 215. That's a significant saving on the estate. But if you were able to take that as a flexi payment term lifetime mortgage with the mandatory payment for 8 years, because that travels with a much lower interest rate of 6.46%, and he's making that payment, the actual total cost of borrowing over the 15-year periods drops to a massive £161,000. So that is £120,000 saving on that total cost of borrowing over that 15-year period from the starting point. So it's a great way of actually protecting the estate for the customer. So in terms of affordability, okay, so obviously we know that what we need to do here is actually sort of assess for income purposes, but we're only assessing for income purposes on the difference, okay, between the two. So as we've already mentioned, you could get up to 8% more, okay, so the assessment is definitely sort of only on that additional section. And if you think about this, okay, so compare this to a TIO or a RIO out in the marketplace. What we've actually got here is, we're covering a much smaller portion of the loan, making this much more affordable for the customer, particularly for those customers who will be entering into retirement. So let's do this as a comparison, okay? So here we've got a situation. This is Julie. She's 55 years old, and she's got a house worth 500,000, and she needs to borrow 120,000. Now, what she could do is she could consider that term interest only loan, okay? And let's assume that this is a 5-year fixed rate of 4.28%. That would give her a monthly payment of £431. Now, we don't know, as it stands at this moment in time, what that payment would be post that 5-year period, because obviously we don't have a crystal ball, we can't see into the future. We know that at the moment the reversionary rate would be 8.24%, and she would be contractually tied in for a 15-year period. So that would take her to age 70. Her other option is she could take a RIO mortgage, okay, and again a 5-year fixed rate, slightly higher rate, 5.74%, okay, and you're looking at a monthly payment there of £572, again based on a 5-year fixed rate. We don't know what that will be in the future, but contractually that could take her to age 87. Now, I'm not sure about you, but I would not sure I would really want to be in this position of being in my 80s and actually still having to maintain that type of payment. The option is here, if she took the payment term lifetime mortgage, okay, so slightly slightly more on the rate, okay, but not too much, she would only have to commit to paying to us £284, and it would be over a much smaller contractual term. So what that does is that gets tenure for the customer, guaranteed tenure for the customer in a much shorter period of time. And it means that she's only sort of 66, okay, basically at the end of the contractual payment term. But let's just say, for example, okay, so you've carried out your research, we've established she's got the ability and the willingness to pay, but let's say she could afford the term interest only of £431 per month. Now, it may not be that it adds up on paper from a lending perspective, but the client knows that she can actually sort of do this. So if we apply that £431 payment to the Flexi Payment Term lifetime mortgage, then what we see there is a significant drop in the contractual term, which would mean that actually her contractual payment term has ended by the time she reaches age 61. So that's a much sort of better position for her to be in. So let's look at our features on this. Okay, so what we've got is we've got the ability to overpay by 10% per annum, and that's ERC free, so that she can make 12 payments a year, and she can either pay by sending us a check, and yes, we still get checks in every single month. She can actually pay us over the phone using her debit card, or alternatively, she can set up a standing order, and the standing order can start and stop as and when she wants it to do so. The ERCs are fixed on the product, so she knows exactly sort of where she would stand. And also, in the event that this was a joint application, we have our compassionate window built in. And what that means is if you've got a customer who is in a situation where one party should sadly pass away or move into long-term care, then what we do is we allow them a 3-year ERC window from that point in time that they can redeem the loan ERC free. And I'll give you a great example of that. So we had a situation where a couple bought a house using an equity release, and essentially they moved into a village type location. Sadly, a couple of years down the line, Mr. passed away, and he was the driver of the two. So it's the type of village where the bus doesn't come very often, once or twice a week. So the client actually found herself having to take taxis into town. So she said to her advisor, I would really like to be in a position where I can port my mortgage onto a property closer to town. I think I need to move out of the village because the bus isn't frequent enough. He said, well, actually, why would you want to do that? So at the time, interest rates had fallen from where they were. So he did say to her, look, you've got the ability to actually redeem your loan, ERC free, and actually take out a new loan at a lower rate of interest because interest rates have changed. And that enabled her to pay that loan back, no charges whatsoever. So it worked really, really well in that situation. And then obviously we've got downsizing protection that's built in as well. So after 5 years, the client can repay the loan in full, okay, free from ERCs, should they move into a new property that's outside of our lending criteria. So as a recap of product overview, minimum age is 55 for all applicants, and the maximum age at the end of the mandatory repayment period is 66 for the oldest borrower. We have got minimum loans on this, so just watch out for that. And also maximum loans, and there's a calculation and a table with those in that we can provide you with. Minimum property value is £125,000 or 150 if it's an ex-public sector house or bungalow, and £2 million maximum in England and £1 million in Wales and Scotland. The arrangement fee of £999 can be added or deducted from the loan. And obviously, as we've already talked about, obviously voluntary payments can be made up to 10%. And obviously there is a fixed early repayment charge that's there for 15 years. It reduces by 1% per year. It starts at 10%. And then when we get to year 10, then actually it remains at 1% for the remaining 5 years. So how can you source on this product? So you've got two options. You can come into our portal, or alternatively, you can source through air sourcing. Now, it's really important that basically when you carry out a sourcing session, that you're doing a full source, okay, on this one. So you're inputting all of the client's details, including their dates of birth. So when you do a quick source, it only asks you for the youngest applicant, okay? It only asks that information. On a full source, it will ask you for both of their dates of birth. And that's really important for driving the product in the right direction. Okay, so you can ask it to show the maximum initial advance as well. Okay, so you can do that. And also, when you get to this section, it's really, really important that you select that toggle that says mandatory payments. So it's the second box down on the left or the third one, whichever way you want to look at this. If you do not select that, okay, then it will not display this product at all. You also then need to ensure that you are providing a budget, okay? Now, there's a little bit of debate around sort of this at the moment. So if you've basically worked out that the customer can afford £350 and you put that in, but what you might find is that, you know, something might come up as £353 or £351, so it's a really near miss. So you can play around with this by putting in a silly budget to sort of start with if you want to. As you can see, the example on screen is £1,000, okay? So that would sort of bring up a variety of different options that are there. And obviously you would know what your client's budget was because you've already carried out that during the fact find. So what we'll then see is the highest release, okay, which will have the lower rates. So in essence, okay, it will display up to 3 products that you will have available to you. So Flexi PTLM, high, low, and also medium, okay? And the high, low, medium is actually relating to the portion of the loan that is allocated as the equity release that is sitting there. So, okay, there are filters here that you can apply, okay? So if you go into essentially the product and payment section, so if you open that filter, what will then happen is you'll get the option to pop on there the monthly commitment, okay, so as a mandatory payment. And you can also put a term in there as well. So obviously what we know is if the client is age 55, we know that that's not going to be, it's going to be 11-year term, it's not going to be any longer than that at all. So if you're working on the oldest borrower, okay, at 66, we know what the term will be, and it's worth entering that in at the same time, okay. So what will then display, okay, is if you hover over, okay, the payments box, it will show you monthly payments, okay, and you've got there £603 in total contracted. Now, remember at the beginning, obviously £1,000 was put in, and it will show you that the payment term is for 5 years and 11 months. However, if you go back to your filters and you select the maximum affordability toggle, okay, which is sitting under the years, so you've got 7 years, and then you switch on that maximum affordability toggle, go back to the screen, okay, what it will then show you is, okay, well, there's £800 total. So in fact, if we actually go back to the previous screen and you put the £800 maximum in there, what will then show you is it's £603 contracted, £197 is voluntary, okay, and that brings the payment term down to 4 years and 3 months. And it won't give you the option of more than the 10%, so it knows what the 10% payment would be. So it's really important that when you're running through the search engine on air, that actually you're completing those mandatory fields in order to get the product to display. Now, if any of you are struggling with any of that, then we can run an independent session on that as well if you would like to do so. So obviously the eligibility criteria and the ability to be able to pay. So we know obviously the age is 55 to 62 at application, and we know the oldest borrower must be no more than age 66 at the end of the mandatory payment term. But they must be a permanent UK resident with indefinite leave to remain. They must have 3 years proof of UK history, and they must be earning an eligible income that we've already covered off. So 2 years trading or at least 6 months minimum employment, okay, or be in receipt of a pension. Investment income is acceptable to a maximum of 10% of the overall income, and we won't take any more than 50% of that investment income into account. And we can lend in and into retirement. What we do have to do is we have to ensure that the client can afford it now and in retirement. And we also have to ensure that there's a first death stress test carried out as well. So in the event of a couple and one person should die, we need to make sure that the remaining party can afford the loan on their own. From an adverse credit perspective, we do really want these clients to be quite clean. Okay, so no CCJs in the last 6 months, no defaults in the last 3 years. If there are some small defaults for utilities under £250, we will ignore them, but no payday loans, okay, and no arrears at the time of application, and no more than 2 months arrears in the last 3 is a worse status. Bankruptcy, repossession, and active DMPs and IVAs are unacceptable. However, that said, from a DMP point of view, if you've got a debt management plan in place, then what I would recommend that you do is, if this makes complete sense to go down that route, let's look at see if we can put a good argument to the funder to see if they'll do that as an exception. Now, obviously, this is a live pricing environment, as Flexi has been now for a little while. You have 21 days validity on your KFI, okay? So you've got 21 days to get that application submitted. And my recommendation to you would be that, because from the time the application is submitted, there's 42 days that we've got to get the case to offer. Now, on this, what we will do is, when the case comes in, we don't always instruct the valuation straight away. We will look for the paperwork and everything to be underwritten. So use your 21-day KFI time to gather up those bank statements, those pay slips, or whatever it is that we need to support the application, so we can get that valuation instructed ASAP. And then offer to completion, obviously you've got 42 days on the first offer. We can extend by a further 30 days as well. And obviously the live rates are available in FastPath at any point in time, okay? And obviously you can secure a new rate by keying a new KFI at any point in time. And as always, this is part of our Flexi Rothsay range, okay? So obviously you do have to upload the suitability report to the secure repository system, basically when the case has completed. So thank you very much for watching this presentation. If you do have any questions at all on any of our events that are coming up, or anything that we've said in this presentation, then please do feel free to get in touch with any of us. We're all here to help and support you. And please look at the Learning Lab Live on our website for future topics that are coming up, and please feel free to book onto them. So we are running 2 sessions per day, every single week, but a different topic every week, and there's some really exciting things to come, so we look forward to seeing you on one of the future presentations.